Socials here. All right. Get the party started. Hello, Smart Money Cheap podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Hagren. Hey, Doug.
Hey, Kirk. How you doing today?
Doing great. Doing great because I don't live in Minnesota.
Hey, listen. I want to start today with a controversial statement. I am tired. Oh, no. I am tired of ICE. It has infiltrated cities all over America, especially up north. It's everywhere. Sidewalks, driveways, parking lots, streets. It's lurking. It's just waiting for you to slip up. And I know this isn't going to sit well with people listening, mostly hockey players, snowmobilers, and ice fishermen. I get it. You've had a great run. But the rest of us, we're done. Christmas is over. The novelty's worn off. It's officially time to put this ice away. I'm ready to start talking spring, Kirk.
Well, actually, I'm looking forward to ice because
I know you are. You're one of the
my ice has melted in my drink. And my backyard, it's been like 47 degrees for the last few days. My backyard ice rink is basically a winter pool again. So I need more ice. I need ice.
Like you, the pushback. I knew I was going to get it today.
Well, it is once again cold here in the Northeast, and stuff is freezing again. And I walk the dogs. I'm like, God damn! Like I had to get back inside.
When your puppies are looking up at you, like, what the is this? Like, it's
we are all our ice is melted. It was like in the 40s. It was crazy. My ice rink was a disaster. So lots of rain, but actually we're gonna have a cold snap for the next week or so. So I'm excited about that. We can actually skate in my backyard again.
Yeah, it's coming back. The last couple of weeks look pretty cold. So.
That's exciting. But I know you got a lot going on in the land of 1,000 frauds, but I'm sure we'll get through it, Doug. So we'll hold a moment of silence for Doug.
The reality is that there is one thing that is always true. It's kind of like they say that, if we have a nuclear fallout, that, cockroaches and Tupperware. The one thing that coming out of this that is absolutely guaranteed to be true, and I'm already seeing it, is the rhetoric on extremes. If you're not with me, you're against me, shut me down. And that's the part that I think most of us, going back to the late aughts, the late teens through COVID, are all getting tired of. It's like dialogue. I play tennis with someone who's telling me last night that a friend of theirs actually was picked up off the street and is now disappeared. All they know, they're in a detention center in Texas, and they're very upset about it. But the reality of the thing is, they're still talking about it, and they're still having conversations. And that's the thing I just want to put out there is, let's keep talking, because the day we stop talking is the day everything falls apart. And unfortunately, there's too many people just ready to do that these days. So
yeah, no, I hear you, man. I hear you. It's tough.
So speaking of, it's a podcast.
Anyway, we'll get you through it, Doug. You'll be okay.
I appreciate it.
All right, so we're going to talk about. There's a lot going on in the world, obviously. I mean, the Venezuelan president was perp walked. You have what's going on in Minnesota, which seems to be a nonstop slow motion train wreck.
NATO is officially protecting our northern side by loading up Greenland with their military. So we don't, at no cost to us except maybe reputation. So that's awesome.
Yeah, I haven't followed the Greenland news, but I've heard that have we reached a deal? Like I heard something.
I haven't heard a deal recently, but I heard that NATO, European Union sent a bunch of military there. I think the total numbers of the military came out under 100 that were sent, from what I read.
To defend it or to protect us? I don't know.
To defend it from us, but that also, But I think that again, this is Trump for you, right? He just got Europe to defend our northern border from Russia for free.
I know. I have to say, for there are people who love him, there are people who hate him.
He's really annoying. I mean, he's controversial. He's going to push every button on all sides.
He's a master troller. I've never seen anybody do this where whatever he does, he can always eke out a win on it, right? Yeah. Like he came out with he had some statement like last year when he said, "I'm going to take guns away from trans people because they're crazy." So he caused the left to defend gun rights. I was like,
that's the point.
Like, this guy's a genius. Like even if you disagree with it, you have to admire the strategery of that statement and what it did. But anyway, I want to go down the
knows
politics
there will
track.
always be a reaction, and that's his win.
Yeah, exactly. He needs the energy in the room to get stuff done. All right. So we'll get off politics. I know it's too much fun these days because there's so much of it out there that and everyone's talking. So let's not talk about that. Let's get into the financial markets. There's way too much to talk about there too. Those of you who have been sleeping or new to the show, or frankly haven't been paying attention to us for the last year,
We will try to do better so you don't fall asleep during the show.
Precious metals are doing okay. That's all I'm going to say. They're doing okay. You know, they're down a little today, but frankly, given what's gone on in the last 9 months, it's been a little crazy. So we're going to start with a little talk about that. There's a bunch of charts I wanted to share that I thought were interesting, just to give everybody perspective. And so I've seen some of these trolling around, so kind of wanted to walk through them. This is the gold to silver ratio throughout history. Okay. So we're going to talk about gold and silver today a little bit, because I think there's a lot of people talking about it, and there's a lot of junk out there, a lot of speculation, and a lot of BS. I'm going to try to share stuff that's not BS, or stuff that's I'll at least explain in a way that makes sense. But anyone who's talking about, well, they know why silver's taken off or gold's taken off, they don't know. No one knows. You can't know. It is unknowable. You can have a supposition, you can have a theory, but you don't know. Like, there is no knowing in the financial markets. There's only guesses. So if you look back in history, and this is going way back in history, it was basically, call it, 1 to 10. 1 ounce of gold, 10 ounces of silver, somewhere in that neighborhood. 1 to 15, it was in that range. So basically 1 to 10, 1 to 15 is probably a reasonable number for long-term expectations. Now, for quite some time, there has been a discrepancy in this in the recent past, where we got up as high as 121 or 109 to 1. It was really high. And that was, I think, back in April or May. And I noticed that. And that's when we got really bullish on silver. But if you look at the history of it, right now it's actually not 1 to 91. It's actually closer, I think, to 65, I believe. Either way, it's still out of balance. And so when you see what's going on with silver, and if you haven't, please pull up a chart. I don't have one here. Maybe Doug can throw one on there. Here we go. Here's a chart. I found one. Don't worry about Doug. So here's the gold to silver ratio. Okay. And this actually, it doesn't account for I think 2020 was a little different. That was during COVID. That doesn't really count. But if you look here, it was over 100 to 1, which is really high. If you look back in the 70s, it goes as low as 15 to 1. In 1980, 15 to 1. 2011, it got to 30 to 1. So if you kind of look at this, and this, I don't want to call this a chart crime, but it borderlines on that. I'm just sharing this for perspective for the historical chart of gold to silver ratio, where it got really high recently, and then it's kind of fallen off, which is a good thing, right? But there is a balance where silver. So if you think of it this way, you have two assets both going up. Right? They're both going from the lower left to the upper right on a chart, or in this case, from the lower right to the upper right on a chart, as silver's doing right now. It's going to the moon, as NVIDIA did when it started to take off. The thing's just going straight up. And so there's two things going on here, and this is how to think about it, right? If you look at gold is not skyrocketing. It's going up, but it's not skyrocketing like silver. So the fact that gold isn't skyrocketing and silver is should tell you that what's really happening is one of two things. One is there's a rebalancing of the ratio, because the ratio has been historically high, where silver has been undervalued compared to gold, and that's a historical anomaly. So at some point that has to correct, right? And it doesn't mean it's correcting because it's imbalanced. It's correcting because there's what we call reversion to the mean. At some point, some shape or time, things will correct just because that's what they do. That's how all markets work. Extreme one direction, extreme the other direction, and then they try to find a balance in the middle. So between gold and silver, you should expect a rebalancing, which is what I see happening right now. Now, will that maintain that? I don't know. It depends why silver's rebalancing. But I will say this, that there's another piece to this, which if you hear all these people chin wagging about silver, there's not enough of it in China and blah, 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 blah. Okay. What you're not hearing, and what was clear, we shared this a few weeks ago, was silver. If you looked at the list, and I'll see if I can find it here, there's a list of strategic commodities that the government has put out that says we deem these as strategic commodities, and they are important to the stability of our nation and our economy. And I'm trying to go back and find all these charts. But that list, maybe it's not going to show up, but that list that I shared, it has on it silver. Silver is one of the strategic commodities. So what you're not hearing is that from many people, because they haven't actually looked at the list of strategic commodities. And by the way, I'm still looking for it. But if people realize that, and you know what's on the list, there's a bunch of rare earth minerals. And I can't even tell you what they all are. Here it is. 2005 list of critical minerals. And this is by the USGS. This is basically by the US Department of the Interior Geologic Survey. This is a government page. This isn't something I came up with or some other, wanker came up with. This is a government page. Aluminum, arsenic, boron, you got cobalt, copper, right? Copper. Oh, there you go. Copper is important. We need that. Germanium, graphite, potash, platinum, palladium, nickel, manganese, magnesium. I'm not going to go through all these. Lead, blah, 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 blah. Silver. Here you go. Silver, silicon, silver, zinc, uranium, tin, titanium. There's a bunch of things on this list. I didn't hear anyone talk about this. Silver. Why is that on the list? Well, oddly enough, it is a really important industrial metal. It has a lot of use cases, and we are running shy of it. It is also a precious metal or a monetary metal. So on top of the fact that we have a precious metal, which is historically deemed as the wealth of the middle class, the gold is the wealthy, and the middle class is silver, and copper was like the poor. If you go back, way back, that's kind of how they looked at it. So silver is an important monetary metal and has been for quite some time. On top of that, it's critical for many things, industrial uses. So if you have something like that, and they haven't really, the problem with silver is you can't really mine it. Silver, there's not a lot of silver mines. Silver is a byproduct of other mines. So that's the big problem with silver. You can find gold mines, you can hunt for gold, and there's people who do it and all that. Silver mines, there are a handful, but most of it is just a byproduct. You're mining gold, well, there's some silver there. You're mining, copper, there's some silver there. And so they do sell it, but it's not like it's a silver mine. And it's not thrown away because it has value, but it's not like you're finding an asteroid-sized piece of silver and you just mine it over years. That's one of the problems with silver, and that's why it's really hard to find, and the industrial uses are using it up. It is used up. It is not coming back. It is used and thrown into some iPhone somewhere, and it's going into a landfill. So you're not exactly able to collect it. Although there are some people, based on the price now, who are trying to recycle silver from electronics and other things that it's used for. So I only mention this just because it's such an important piece of the puzzle that no one's talking about. Is that why silver's going up? Like I said, I have no idea. No one does. But if I was to hazard a guess, I would say there might be some shenanigans going on with people that are trying to capture as much silver as possible because they don't want the Chinese to have it, or whatever the reason is. But prices don't do that. Okay, that's all I'm going to say. If you look at, I'm just going to have to bring up the chart in silver because I've been talking about it so much. But here we go. Here's the silver price. It's obviously down today. Let's see. Oh, crap. That's not what I wanted. Let's see. Here we go. All right. Here's a silver chart. Okay. It shouldn't do this, right? If you look at this, it's kind of hard to pick up because if you're looking at this, you're probably seeing, okay. Well, it's not really doing what I wanted. Okay. Anyway. So if you look at silver, it's kind of gone nowhere and it starts to pick up a little bit. And, you know, it did pretty well throughout here. And then December happened and it skyrocketed. It went from basically $50 up to $93. Okay. Now there's claims that in China it's at $100, which may be true. There is a discrepancy between U.S. silver and Chinese silver because China has stopped imports. So they're trying to take as much as they can and not have it leave the country. Kudos to them. They're basically doing what we're doing. They're just taking. So if you look at the grand scheme of the playing field globally, right? And here's gold. Gold has not had the same kind of run. It's just slowly creeping up here, little by little. You know, that's okay, right? That's actually a good bull market. That is a healthy bull market. This is not healthy. This is an unhealthy bull market because what it means is it's spiking and then it comes back down and it causes people to freak out. It's unstable. So I would be careful of silver. I'm not saying it's not going to go higher. It probably is, but I would be very careful. Here's platinum. Platinum has also had a big run in December and has actually, it's kind of working off this run. This is actually a bullish behavior. It's kind of working it off. There's a triangle here anyway. So copper had a huge sell-off. It would have been a great time to buy it. And then it's done very well. And, you know, as long as we don't go into recession, copper should probably continue to do well. So what I would suggest is if you're looking at precious metals and thinking of adding them to your portfolio, you really need to start thinking about why do I have it in there? Why is this going to be a part of my portfolio? Because there's two sides to this. One side is, you know, I've always had for a long time gold as a part of the portfolio. It might be as little as 4% of the portfolio, but it, you know, if you look at the World Gold Council, and actually did a lot of research on this a while back, and this is years ago, they said that 4 to 8% gold in a portfolio is a good amount to balance it out. And I read that and I was like, okay, that's interesting, right? But then we've had guests on the show who are really smart people who have like a quarter of their portfolio in gold, like 25%. Okay. I don't know what the right number is, and you all have to figure out what the right number is for you. I'm not going to share that because I can't give advice on the show. I'll get in trouble. I can give advice to clients, just not the general public. So what I would say is when you're thinking about allocations for precious metals, think about it like this. Is gold a allocation because you're trying to balance everything else out? Or and I say gold, what I merely mean is gold, silver, precious metals, mining, that whole kind of sector. Are you doing it to balance out the rest of the portfolio? Are you doing it because it's a trend and you want to jump on board? Or are you doing it because you're afraid of the monetary system and you want to make sure you're protected? Now, those are three separate things that you could use to allocate precious metals to your portfolio. It does matter which one of those or ones of those are the reason you're doing it, okay? Because if you're doing it for allocation purposes, you might look to the World Gold Council and say, yeah, we just want to balance out everything else. We want to figure out a nice allocation. If you're looking at it as a trend, then you might say, well, maybe I want to find a way to ride this trend a little bit because the trend's been pretty strong. And it might get a little rocky, but it doesn't seem like it's ending in the near future. There's way too much going on for the precious metals trend to end. It might not go up like it did last year. Let's just be honest. It probably won't. But will it have some opportunity? Yeah, I think there'll definitely be opportunity this year. Now, if you're worried about the monetary system, and I've talked to a lot of people who are, then they feel very comfortable having a larger percentage of their account in precious metals. I would just be wary of that. I think we all think that the world's going to end tomorrow because that's how our brains work. You know, our brains go to the extreme. We think that the thing that we think is going to happen immediately. You know, a lot of people say, oh, we're going to lose the world's reserve currency. Yeah, I agree. But it might not happen for 50, 100 years. We don't know when it's going to happen. It's not going to happen tomorrow. So are you going to reallocate your portfolio around that for tomorrow? That's not smart. So think about, and it's not, you know, fear is a big part of investing. You have to understand fear and you have to be able to manage fear. And if you're afraid of all these things happening and you can't use your executive function in your brain, when fear hits, your lizard brain takes over and your executive function stops working. That's the problem with fear. We all have it. That's, you know, fight or flight. Your brain stops working. You stop thinking. You stop being able to rationalize. You just do. And your animal brain, your monkey brain takes over. So what you want to do is you want to start thinking ahead and try to think about, like, all right, what are the things I'm afraid of? When could they happen? Could they happen tomorrow? No. Could they happen next week? No. Could they happen in a year? Probably not. Could they happen in 10 years? Maybe. Could they happen in 50 years? Probably, right? Just think through probabilistically, like, where it falls, because, you know, a lot of people prepare for the end of the world. They prepare for the zombie apocalypse. They got their gold, their guns, their MREs. But if the world really ends, who cares about stocks? Like, I'm going to need my guns and my MREs, my plenty of ammo. That's all you're going to need. All the rest of it is useless because all you're trying to do is survive. I don't need to prepare for that with my portfolio, because if that happens, who the hell cares what's going on? I'm not going to be doing this podcast if that happens. So if all of you were expecting that, I'm just letting you know in advance, this podcast will stop if the world ends. So just letting you know. But seriously though, like, we all tend to go to the extremes. That's how our brains work. So try not to think in the extremes. Like, silver's going to go to like $5,000. No, it's not. Okay, it maybe, but I'm just saying it probably isn't. I would not plan for that. So if somebody comes out with some outrageous claim of what it's going to be, just say, oh, isn't that interesting? And try to find some facts. Don't just get hijacked because somebody puts out some crazy thing. So taking it back to how this helps you, think about why you own it. Why you own it matters in terms of allocation. You know, there are plenty of allocations you could look to historically with a lot of data that will suggest an allocation based on what you think your thesis is. If it's money devaluation, your allocation might be higher. If it's just having a diversified portfolio and low risk and all that, and diverse, and you know, we talk a lot about that in the show, so I won't go into it. But if you're into that, then it might be lower. So figure out why you want to own it, and that will determine in some ways the allocation. Because if you're just looking at the trend, that's a temporary investment. You're just on the train until it stops, and then you get off and you get onto some other train. And that allocation is dependent upon what kind of risk you're taking. But there's a lot of variation between that. And a lot of people are uncomfortable, like in the big brokerage houses, Merrills, Morgans, UBS, like, they don't want you owning gold. Now, they have supported gold and they've researched around this for years, but they don't want them owning that. When I was at UBS and Smith Barney, they clearly told me you shouldn't have that in the account. Not that you can't, but you should go find a stock. We don't like that. So, you know, people are coming around, firms are coming around, they're coming around to, you know, cryptocurrency, they're coming around to precious metals. A little too late, you know, it would have been nice to be in years ago, but that's okay. So just think about how these things impact you. Before I get into the next section, Doug, what are some of your thoughts here?
Yeah, I think precious metals are definitely not a one-size-fits-all solution. I like that. I like what you're saying, that there's a lot of different people with a lot of different philosophies that are, that are either very bullish on holding on to it for things such as the monetary policy, but there's also individuals, and we look at the data out there of how many accounts, and again, a lot of that might be recommendations from wirehouses and such that aren't necessarily as bullish on it for maybe their own personal, entity reasons, because that's certainly not, maybe with an ETF or such, but otherwise it's not really a place they have typically been able to make money. So maybe some of that is the advisors themselves are kind of behind on adjusting allocations. There's a lot of static models out there that, honestly, if you're out there with one of those portfolios from some of the big names, you probably don't get a lot of adjustments. They say they're managing it, but we know if you look at our conversation in the last 12 months when we started talking about precious metals, and looking at that gold silver ratio, we said it then that there was no way to certainly guarantee what was going to occur. But that's, like you said, be cautious right now. It's interesting that, yes, while there is a fundamentals side to investing, the fundamental side to investing has often, at least in the current world, where the current decade or so, has been overshadowed very heavily by the technicals. And so when you start looking at that gold silver ratio and you start to see that it's really, really stretched, there's probably a higher probability that it's a good time to get into that before it snaps back into a reversion to the mean. We are seeing that has started to do that since then. There's been and those that got in early have benefited from that. Is there still room to run? Yes, but we are now more in line with historical ratio than we were before. So the opportunity is less potentially than it was. But we're still, like I said, a lot of, we said this a year ago, adjustments, some people listen, adjustments made. But if you look at your portfolio and it wasn't added, again, a lot of people are under the misconception that their accounts are actually being managed. And what I mean by that, meaning look at what's going on in the world and look at what's probably the right fit right now. And it doesn't happen for, unfortunately, most people out there. Whether you're managing it yourself because you don't have the time to do that type of research, maybe you're listening to us or something, but certainly not, in most places where that's being managed by a shop, because they are not only, again, their own best interest, protecting things, they stick with it, they use history, and certain portfolio theories that, can argue that are effective, but they just don't ever sway from. So, heavy allocation might make sense for some investors. It might be completely wrong for others. It depends on risk tolerance, time horizon, liquidity needs, what you're trying to protect against. And where noise creeps in is, as you said, there's a lot of talk about talking metals down, not always because they're bad investments, but they don't fit neatly into these models of proprietary platforms. So if it can't be custodied easily or managed easily or built on easily, all of a sudden it can be mislabeled as risky or speculative, more so than it may be. And it doesn't make metals good or bad. It just means that you have to really understand that the incentives matter. So before you add anything, gold, silver, real estate, or alternatives, run the same test. What job is this asset supposed to do? Where is it maybe in the technical history of things? Does it look like it's undervalued historically to some of these? There's probably a better chance it's going up, unless there's some significant reason it might go away, which is probably more likely a company that might become obsolete than a precious metal, right? Or an index. What risk does this hedge? What does it cost you? Very importantly, in liquidity, taxes, and flexibility. Because owning something without reason, that's not diversification. That is just hope with a ticker symbol. And a reminder that I said, I want to come back to the taxes really quick before I turn it back to you. I said this in the last week or so. But another reason to potentially look at the diversification and the holding of some of these assets, like cryptocurrencies, for example, is the fact that they may not be labeled as a security. They may be labeled as a property. If they're labeled as a property, which again Bitcoin currently is, then it's not under the same rules that other securities are, stocks are. So one of the things that you should be looking at, especially you should be looking at taxes all the time in your portfolios. If it's an IRA, a Roth, or pre-tax, then the tax management is going to come from when you put the money in or when you take it out, or whether or not you're doing conversions. If you have a taxable portfolios or anything that's not in a retirement account, that taxation decision has to be made consistently, has to be made on what kind of dividends or interest is that producing. That's going to hit on your 1040 as interest and dividends, and it might be taxed at capital gains rates like 15% for most people, or 20 if you're higher income. But it also it also might be taxed at ordinary income, which again could be in the 30% bracket depending on who you are. You also have to then be cognizant of when you buy it and when you sell it. If you sell it less than 12 months, well, you're going to be paying ordinary income on that gain. If you sell it over 12 months, you're going to be paying capital gains, again, back in that 15-20% range. But guess what? That doesn't apply to crypto, to Bitcoin. So if you hold Bitcoin and it's down because you got into it at 120 and it's now fallen to, what was it in the 70s again? I think it's back up near in the 90s, but that's a $30, $40, $50,000 loss on when you bought it. You could sell that today, buy it back tomorrow, and capture that loss. And that's a huge tax planning strategy. And you've never been without it. Whereas if you try to do that with a regular stock, whether it's even crypto as an index, is an ETF, that is now a security. And if you do that and you sold it today and bought it back tomorrow, well, the IRS is going to pretend like you never sold it. So you don't get to capture it. It's called a wash sale. You got to wait 31 days to buy it back. So understanding those things and having those things in your portfolio and understanding how they're registered with the government, again, something you can watch very closely. It takes some tremendous opportunity there around tax management. That it goes beyond just, is it a cheap time to buy it? Is there opportunity? Is it an expensive time to buy it? Is that opportunity gone? Should we be selling for risk purposes? Tax management is something I would really pay close attention to, and that's another reason why some of these things make sense.
Yeah, that's good, Doug. I appreciate it. I think taxes are something we don't always think about, but it's an important part of the investing process. I want to get into a few things here. And we talked last week about what was doing well in the first week. We're a week and a half in, and frankly, some assets are up 5, 6, 7%. Asset classes, some assets are up 50% in the first 2 weeks, but like certain asset classes are up, like I think small caps is up like 5 or 6% in like the first week and a half. It's crazy. So, but what I wanted to do is I wanted to talk through like high level for the year, and I thought this is actually a good graphic that somebody that Bespoke put out about U.S. equities. Now, we just went through a great year. Well, let's say a good year, 17% and change up for the S&P. International markets were double that, if not more. So in comparison, the U.S. actually didn't do great. International markets did great. Precious metals did great. U.S. stocks kind of just did, better than average in recent years. No, 17% is that's no slouch right there, but still, in comparison to what everything else did, it was a laggard. So, in looking at this, there's definitely some. Actually, I'm bring this chart up first. In looking at if you consider the U.S. compared to the world, right? This is price to book. This is one of those metrics that people use. People use a lot of different metrics. Price to book is one of them. It's kind of a uniform metric because you're just looking at what's the book value of the company and then what's the price. It has nothing to do with earnings, which are different. It's characterized different in different countries. But if you just look at this, right, there are times where the S&P 500 is really pricey in compared to the rest of the world, and there's times where it's not as pricey. And if you look here, you can see clearly that when it's pricey, it tends to be kind of peaks of the market. I don't know if this will be a peak, but in comparison to the rest of the world, it's all just kind of hanging out here. And we've just taken off and left them behind. Now, there's reasons for that, because globally, people didn't feel comfortable with other countries. Now, with Trump in office, you'd think, well, America first, right? Well, America's going to be the best place to be. No, that's not what's ended up happening. What ended up happening was international markets were the place to be. The U.S. did well, but international markets did so much better. Now, I think that trend's maybe not long term, but as long as the dollar is weak, then you need to be aware of that. Now, before I get into this, I want to make one. I kind of want to walk through this one concept, and I've heard it a few times recently, and I think as I've thought about it, it makes the most sense. Here's the thought. Now, for a long time, the US has been in this place where we are the leader of the world in many different aspects. We're the global reserve currency, we're the policeman of the world, we lead in many different industries, and we're so successful that we have to apologize for it. We have a whole segment of our society that feels guilty for their success. And as a country, in some ways, we feel guilty for our success. So we belittle ourselves because we don't want to be seen as bragging, if you will. And it's hard because there's not a lot of competition. And so when you think about it that way, you think of all the things we've done. We've attacked other countries. We've had many skirmishes, not wars, but skirmishes. And we put a facade up that it's to protect the people. Like, no, it's not. You're not over there protecting the people. We haven't done that in a long time. But if you think about kind of what's going on globally, we have a different facade right now. We have a different perspective on the world, right? And this administration is just saying, we're doing things because we're doing them. We went to Venezuela for the oil. Oh, usually we would come up with a good excuse. This time there were no excuses. Like, here's what we're doing. And as I was thinking about that and reflecting on perspectives here for the economy, what I started to realize is, so first of all, Trump wants a good legacy, right? He doesn't want to have an administration over like the worst economy ever. He doesn't want that, right? He's into his legacy, he's into his ego. Like him or hate him, his ego is a big part of who he is, right? He wants to be remembered. So what is the best way to do that? Well, the best way to do that is to have a rip-roaring stock market. Well, it's hard to do when the stock market's already expensive, we're already hyper-levered, we've got way too much debt. It's really hard to expand things from here. So here's a few things that can happen. I should probably pull this chart up first. So if you look at the markets, they can kind of run in a few different ways. And there was a really good chart here. I forget who put it out, so apologies if you deserve credit. And it's these different frameworks. Now, traditionally, you can have, and this chart is basically, there's an X and a Y, there's prices and economic activity. So the vertical is prices, the horizontal is economic activity. So you have four quadrants. The upper left is an inflationary bust. An inflationary bust is when you have high inflation and pretty much, and then, the markets go down. So according to this, buy cash in the safest currency, not necessarily your currency, in the safest currency. Sell financial assets. And then there's a disinflationary bust. And in that scenario, you want to buy safe government bonds and you want to sell everything else. So far, so good. Those are pretty accurate. Now, on the right side, you have something that we don't really think of. On the lower right, you have a disinflationary boom, which is buying innovative companies with pricing power, sell companies with little pricing power. That's pretty much what we've had from 2010 to like 2020. I would argue we had a disinflationary boom, or a very very low inflation. I would call it disinflationary because I think we did have deflation, but that aside, that was why those things did well. Now you have the upper right, which is an inflationary boom, where the things to buy are stores of value: real estate, gold, commodities, high fixed cost, cyclical producers, sell long-term bonds. Now I use this chart because the theme that seems to be running here is run it hot. Now, Lynn Alden, I'd love to get her on the show. She talks about you can't stop this train. There's a new theme. I heard somebody say it once. It hasn't caught on yet, which is run it hot. Now, here's what that means. Run it hot means that you're trying to get a lot of growth and you're trying to get inflation. So inflation's not a bad thing. We all think high inflation's a bad thing. Inflation's not a bad thing. It's a bad thing if you can't control it. But if you have inflation and you have a growing stock market, a growing economy, that's good. That's really good. If you think about when we came back from World War II, right? All the soldiers came home and they got back to work, and then the economy started to take off. People started buying houses. They want to have kids. And you had this boom time, which created the boomers, right? The boomer generation, because everyone came back and started to have kids. Well, that was an inflationary boom. You had a real estate, you could get real estate for like $4,000. And then it boomed because, everything was growing and people wanted to buy houses. So you're competing and the prices went up. That's a good thing. There's nothing wrong with inflation as long as it's paired with growth. When you have inflation with no growth, problem. When you have growth and no inflation, that's okay. But if you have high inflation, you also need high growth. So what I suspect is happening and what they're trying to do, and they haven't put it in these words, but that's how I'm deducing it, is they realize inflation's not going away. There's not much they can do about that. I think they're cornered. The Fed is trying to keep it in check. I don't think they can keep it in check. So the only way they can do it is by increasing growth. How do you do that? Well, you do trade deals, you find ways to bring jobs back, you do all this stuff to grow the economy. I'm not sure if they'll be successful. That's another story. But people say that GDP might get to 5 or 6%. Okay, look at China. Okay, China for up until a few years ago had a growth rate of like a GDP growth rate of like 7-8%. That's crazy. And they had inflation to boot because we exported our inflation to them. So they had inflation. It's okay, but they were having massive growth. So the run it hot economy, which is what I'm going to start calling it here, the run it hot economy is what you should expect. So if you looked at that quadrant, you should look at stores of value, real estate, gold, commodities, companies with high fixed cost, I don't really understand that high fixed cost thing, but cyclical producers, you should be focused on those and not owning long-term bonds. Okay. Now, if things change, inflation goes down. Okay. Then you go back to tech with pricing power, and you want to stay away from like commoditized companies with no pricing power. So that's how you should be thinking about your investments, because that seems to be the path we're on. Does that mean we're not going to have some hiccups and the market's not going to go down and whatever? No, of course that can happen. What I'm saying is the more I come to terms with this, the more I think the markets are going to keep going up. And yes, I know there should be a recession, but if they're running it hot, they're going to run over like a steamroller all the recessionary metrics, and they're just going to run it hot. And I think everything they're going to try to do, they're going to pull out all the stops to make that happen. Will they make it happen? I hope so. I don't know. We haven't tried to do this in a long time. Actually, I don't know if we've ever tried to do it. It's happened, but I don't know if we've tried to make it happen. So this is where I said when Trump got elected, I came back and I said, I'm willing to have an open mind. This is it. Okay. You've proven yourself so far to be competent. The question is whether you can follow through on it. So are you going to make it happen? We'll see. I'm open-minded about it. I'm cautiously optimistic, but the way I'm reading this leads to commodities going higher, real estate going higher. You need to be mindful of what's happening here. And if you're in big tech and you think big tech's going to take you the next 10 years, if this is the environment, you're going to be sadly mistaken. So just keep this in mind with your portfolios. Don't think that just because things did well before that they're going to continue to do well. So far this year, big tech has been underperforming by a lot compared to the markets. So just keep that in mind. I'm going to hand it back to you, Doug. I wanted to go over these things, but I don't want to take any more of your time.
Well, that's so kind. Sorry, that's very kind of you, Kirk. I appreciate that. Now, so I've got some. There's a bunch of different charts that I've thrown out there that we can kind of talk around a little bit, unless we want to stay on theme. I think going back to your 4 quadrants. Well, first of all, going into the big message, I'll go back to the first one you put up there, the pros and cons. I think what I interpret it is that the slide is telling is that it's not necessarily. I mean, it's not really a bullish or a bearish call. I think it's a very good representation of a late cycle tension map. U.S. equities are indeed strong, but I think there's still you have to be aware that they are becoming increasingly fragile. The market is still working. It's still being supported. It's still producing winners. Of course, who those winners are, there's where that's the adjustment and the rub. I am, what you just said about tech. I think there's a lot of head scratching going on. Like, how come, when things were running late last year, early this year, Bitcoin was going the other direction? Well, because it's become less correlated to tech. They've done some data on that has shown that recently it has disconnected a little bit, but there's still a tie-in that if you look at the correlation there, it is a technology. And so when you're starting to see a pushback from tech, that could be something that you're reading in to at least the short-term bullish bearish statement on crypto. On that pro side of things, I mean the trend. Momentum and narrative driven is really what's going right. Price action's on tech. Momentum investors are still being rewarded. Leadership, is narrow but powerful. When you look at mega cap tech versus AI, and skepticism, there's certainly some worry out there, but it hasn't killed the rally. I mean, liquidity still matters. Being flexible still matters. And this economy, hasn't cracked. The margins are holding. It's still climbing. But I think mostly because, it hasn't been forced to stop. When people talk about the black swan events, there's been nothing that has been catastrophic enough to really throw those brakes on. And, we've talked about this before, and people can read about it. A lot of times the noise about things that are going to happen in the markets, good or bad, is really like a gas leak in a house, right? Every day there are houses that have gas leaks, around this country. They don't make the news. Why? Because the one thing that didn't happen was the spark, right? And we've got fumes that are in a number of different areas, but the spark, we've been fortunate that the spark has not ignited it now going on close to 17, 18 years, really. I mean, we've had some volatility between them, but really coming out of the Great Recession, people said we're due, right? Yeah, we're due, and there's certainly things that have been lined up to see that final that big pullback, and you've got the perma bears out there saying it's coming now, but we don't have everything producing fumes, and we don't have that spark. Now, if we go to the con side, I think that's where the truth lives. Cons against the market are structural, their valuation, they're forward-looking. I think you've got some leadership that's thinning. If the top names stumble, there is no bench. I think the prices, with valuations, prices are assuming perfection now. You're at the same time, we're seeing leverage and refinancing risk rise. Is Oracle, a bellwether like Oracle? These may be late stage indicators and not necessarily leaders. So watching that closely, I think, we have to worry about what have you done for me lately? Expectations are already high. So those are the fumes right now. There's little room for disappointment. And if we can continue to have, this bullish sentiment coming in and profits, then great. But when that breaks, it's not an if, it's a when. But again, like you said, it could be 10 years from now. And for many people listening, that's beyond their retirement. When you say, "Oh, I'm going to make these, changes based on what could happen." Well, if it takes 15 years from now for that to happen, and you're waiting for it, and you're adjusting for that, you could really, really, impact yourself. So, again, you got to look at what's going on right now. There's little room for disappointment, but we continue to have good news coming in. Policy and labor risk, those are asymmetrical. There's definitely more downside for that than upside. But with the same time, and I kind of bullish bearish, speculation is starting to creep back in. When I say bullish bearish, it means that we've got positivity right now. Consumers are ready to pounce and make opportunity on this, but it can also be a late cycle tell. So it does look healthy on the surface, but just keep in mind that support beams are under strain. So I'll just say this: the big picture on it. It's not time to be lazy. It's not time to be concentrated. It's not time to be unintentional, but it's also not time to get out. It's just watch the structure. that's going to mean a lot more than conviction. A smart investor is going to, is going to be someone who trims oversized winners, reduces single theme concentration like AI or mega cap tech, balance growth with ballast, separate growth money from income and tuition and near-term needs, and stop confusing momentum with durability. Who's going to get punished in this? All in narratives. Just go. Overconfidence. It worked last year logic, and portfolios that have, that do not have role clarity. So it's a good market with bad habits forming. And I think, if it takes off like you're talking about, Kirk, this, by the way, this is the scary part, is that if we go back and you look at inflation in the 70s, buying houses small, and inflation being a bullish and a helpful thing because there was so much opportunity. The challenge now is things are very expensive already. So with any increase in inflation is straining that even harder. And what's going to be a takeoff if this continues to run, and we see very different than stagflation where you get no returns and high inflation. If we get higher inflation but yet higher returns, it's going to be very problematic for the divide between the haves and have-nots, which is already getting stretched. Those that have assets will win. Those that don't will get hurt.
Yeah, I think it's interesting, and if you look at this list, it's still a bull market clearly. You might think it's overvalued, but that can stay that way forever. So that's, if you look on the con side, valuations are high. But it's still a bull market. And until we know otherwise, you have to assume that that's going to continue. And I know it's uncomfortable. It's like silver. Like we've been in silver for a while. It's very uncomfortable right now. It should not go straight up like this. That makes me very uneasy because I'm wondering why, because like I said, nobody can know why. And so I'm wondering, is this just going to bounce people out and drop 25, 50%? Well, I mean, it could easily happen because what can happen is the CME can just come out and just say, all right, margin requirements are 100%. So there's no leverage. Yep. That'll crash the price of silver. I mean, they've done it before. They did it in 2011, I think it was, where silver was taken off, and they were afraid of. There's a few things they were afraid of at the time. One of which was not fulfilling the futures contracts, but it started to take off, so they just started to increase the margin. They just kept increasing until it popped the bubble, and then it started to go down. So they've started to come out and put some wrangling on the silver market, and I'm very cautiously watching that. So if they come out and start to really put the hammer down, I would be very careful. That's usually a sign that they're afraid, and I'd be careful of that.
Now I'm going to add something to just counter that, because this goes back to the one of the reasons why is silver blowing up. Well, some of that's what we were talking about months ago, right? Is this a fundamentals situation or is this a technical situation? And you're right, if the governments come out, policy can change everything. At the end of the day, don't fight the Fed, right? Or whatever governments, if they put these margin requirements in there, that's a black swan, right? But if we come back to the technicals and we go back to the gold silver ratio, well, why is silver blowing up the way it is? Some of that is likely to do with the fact that the stretch between gold and silver was so strained. So, is silver just coming up because it needs to historically to be back in line with gold? Is maybe less of a conversation about what silver's doing and more of a conversation back to what gold's doing. Because as long as gold stays here, even if it's just going steadily, as long as gold stays that high, if you look at the technicals, then silver should be rising to be in line with those historic gold silver rates.
I'm going to make one more point and I'll give it to Doug to wrap up. So, we'll go through the list more next week, but the thing to remember is we had a good run the last 7 years or so where pretty much big tech, the Mag 7 took off. And if you own that, you did great. If you didn't own it, you didn't do great. That's a different cycle. We're in a different cycle now where that's underperforming. You have crypto tends to perform with high correlation to software and tech companies. So if tech is not doing well, you might watch your crypto. This is not to say that crypto won't do well, but we've had a correlation up till now. That may be changing. But if you look at the markets, we had this everything in big tech and everything else is just is chump change. But now the market is actually moving equally. So the equal weight indexes are actually doing fine, and that's actually a good thing. That's a strong thing for the bull market. It also means value might start to do well because value's been out of favor for so long. I'm not saying it will. I'm not totally convinced, but it certainly could come into play. Small caps are starting to do well this year. I mean, small caps earlier this week were up I think it was Tuesday, it was up 5% in a week and a half. It's crazy. So, understand that just because things have happened in the past doesn't mean they'll continue to happen this way. You need to understand the rotations that are going on. And it seems to me this run it hot economy is going to change the game from what you're used to. So just be mindful of how you're allocating and how you're investing. Make sure that you're protected in case of, black swan events, but also, don't be afraid to change things up. Because I think you'll be happy you did when you're getting good dividend yields. And at the same time, you're also getting growth versus, tech that so far this year has been negative returns, even though the markets are up. So Doug, take us home here.
Yeah, so there's a lot of charts that I didn't get to again this week. I mean, we have so much stuff to talk about. So in our next week's, I'm gonna try to work with you, Kirk, to get a couple things that we can line up here. But I didn't really get because honestly though, it's okay that I didn't get a chance to go through a lot of visuals and those visuals in detail, because the point really isn't any single chart. I mean, when you take a step back and you look at them together, what a lot of these charts that we have and a lot of the information that we look through is telling, it's the same story from different angles. We're in a period of shifting regimes, uneven inflation, concentrated winners, fragile labor markets, and rising costs where it actually matters to families: housing, healthcare, and education. I do have a graphic that shows, and we've talked about this before, that inflation is not, it's not just this one thing. It's a combination of many things, and there are things that are absolutely going up, and there's things that are absolutely going down. And that, when we see 2.5%, 3% inflation, it's like, oh, that sounds great. If all the things you need are at 5, 6, 7, 8, you're going to feel it very differently. Oil prices, they're volatile and they're falling. Headlines can improve. The markets can also grind higher. But underneath everything, the structure of risk, the one constant is change. And this is why it isn't a moment for predictions. It's not a moment for overreactions. It's always a moment for clarity, understanding what you own, why you own it, and what job each dollar you have is supposed to do. And you do not need to analyze every chart to see a pattern. You just need to stop managing money in silos and make sure that you're always planning across realities. Because the investors who struggle aren't the ones that are going to miss a data point. They're really just the ones that never built a structure to handle change in the first place. If you want to make sure that what you have and you're putting together financially for your future is going to be built with a structure to handle change, then check out the process that we follow for making sure that individuals, in many cases, we really focus on younger baby boomers, Gen X, and older millennials, which really I'm calling the Gen X because, again, nothing's covers everything. Those individuals are the ones looking right now going, the rat rate, we want to have the life, we want to have the balance, but yet we are constantly facing the grind and they're getting tired. If you're one of those that's getting tired and you want to see, is there a way for me to get out of this rat race? Is there an opportunity for me to have control? Maybe you want to work forever, but wouldn't it be nice to be the one that has the control of that? And if you want to make sure that you have a plan that's structured for that change, that's structured to give you options, to allow you to be able to look at your life and work and focus on the things that matter the most to you, check out our process and how we do it. This includes college, retirement, taxation. MERGENTadvisors.net, MERGENT, 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 MERGENTadvisors.net. Check it out. And again, I talk about it a lot. One of the biggest things we're facing right now is the squeeze of college. Our process and our philosophy is unique. Most people don't cover it, so you can read more about it there.
Awesome. Well, thanks again for coming on, Doug. And that's the show for this week. Thank you again for joining us in Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on the show. Please remember to subscribe to the podcast and the podcast app of your choosing. You can also check out the show at moneytreepodcast.com. On our website, you'll have access to the show notes, resources, and the archive shows. Please check out our YouTube channel. When you're there, please subscribe and leave a comment. Lastly, leave a show rating and comment on the podcast app of your choice. Don't forget, do your own research. This show is for informational use only. We're not telling you what to think, merely how to think about investing. We're also not selling any products or services, so do not consider this advice. If you have any problems with the show, I blame Putin. Please send an email, express your feelings. If you're seeking financial advice, talk to an oracle or a fortune teller, or maybe just a licensed financial advisor. I'm one, but as I said earlier, I'm not selling anything, but I'm easy to find. Have a great week ahead, and remember, no one will care about your money like you do. So invest in your life.